All right, let's dive right into one of the biggest, most high stakes questions on everyone's mind right now. AI is everywhere. It's changing the stock market, it's changing how we work. But with all these sky high valuations and this absolute flood of cash pouring in, you can't help but get this feeling of deja vu. So, the $1 trillion question is, are we standing on the edge of a genuine technological revolution? Or are we just watching a massive, generation defining AI bubble get bigger and bigger, just waiting to pop? Let's unpack the evidence. I mean, just think about it. It's 2026. Company valuations are shooting into the stratosphere. Any startup that even whispers AI in its pitch deck has venture capitalists lining up at the door. There's this incredible buzz in the air, right? It's a mix of wild optimism and, if we're being honest, a little bit of anxiety. For anyone who remembers the late 90s, this feels eerily familiar. So it really makes you wonder, is this really the dawn of a new age? Or are we all just watching a rerun of the dot-com bust with a brand new cast of characters?
Okay, so before we go any further, we need to be on the same page. What exactly is a financial bubble? Well, basically, it's when the price of something, a stock, a house, anything, completely detaches from what it's actually worth, its fundamental value. Think of it like a hot air balloon that's been cut loose from its ropes. It's not rising because of some steady, predictable force. No, it's soaring on pure hype, on what some call animal spirits, that collective, irrational euphoria and a massive fear of missing out. The price isn't about value anymore. It's about the belief that someone else will pay an even crazier price for it tomorrow.
And trust me, this is nothing new. History is just littered with these kinds of stories. Way back in the 1600s, you had tulip mania, where people were literally trading entire houses for a single tulip bulb, right before the market completely imploded. Then, in the late 90s, the dot-com bubble saw companies with no profits, sometimes not even a real product, get valued in the billions, only to vanish into thin air. And of course, more recently, the housing bubble in the mid-2000s nearly took down the entire global financial system. The pattern is always the same. A new, exciting idea captures everyone's imagination. Rational thinking goes out the window, and sooner or later, gravity kicks back in. Hard. So to figure out if this AI boom is just the latest chapter in that history book, we're going to treat this like a courtroom case. First, we'll lay out the case for the prosecution, all the evidence for an AI bubble. Then we'll let the defense make its argument that this is a true industrial revolution. After that, we'll play fact checker and bust some common myths, give you some tools from a pro investor's toolkit, and finally, we'll map out how to think about what's coming next on this AI frontier.
All right, let's get started. For this first part, we are putting on our prosecutor hats. We're going to build the strongest possible case, piece by piece, that what we're seeing in AI right now is an extreme bubble, stretched to its absolute limit and just waiting for a pin.
Exhibit A for the prosecution, the sheer amount of money involved. Just look at this number, $2 trillion. That's the projected global spending on AI just for this year. To give you some context, that's more than the entire economy of a country like Canada or Italy. And it's not slowing down. It's growing at a mind-blowing 36% a year. When you have a fire hose of cash that big, pointed at one single sector, it doesn't just help things grow. It can create some seriously massive distortions. And this is what that distortion looks like. We're not talking about prices being a little bit high here. Some of these valuations are just in a completely different galaxy from what we'd normally see. So let's break this down. A typical healthy company in the S&P 500 trades for about 25 times its annual profit. Okay, makes sense. Now look at Tesla, which is being valued more and more like an AI company. It's trading at 300 times its earnings. And then you have Palantir, an AI software company, valued at 110 times its sales, not its profit, its total revenue. To believe these numbers make sense, you have to believe in a future that isn't just bright, it's absolutely perfect. That's a huge bet. So, you might be asking yourself, where is all this incredible growth coming from? Well, this is a really crucial piece of the puzzle for the prosecution. The argument is that some of this growth might be a bit of an illusion, a kind of financial magic trick. Here's how it works. Step 1. A tech giant like Microsoft invests billions in an AI startup, say OpenAI. Step 2. That startup immediately turns around and uses that exact same money to buy cloud computing power from Microsoft. Step 3, Microsoft gets to count that spending as its own revenue, making it look like its AI business is exploding with organic growth. It's kind of like if I gave you $100, you immediately used it to buy a gift card from my store, and then I announced to everyone I just made a $100 sale. It looks fantastic on paper, but is it real?
This really gets to the heart of the prosecution's case. The massive gap in what's called return on invested capital, or ROIC. It's a simple question. For every dollar you put in, how much profit are you getting out? On one side of the scale, you've got this mountain of cash, that $2 trillion a year being poured into AI. On the other side, you have the actual revenue coming in from real customers paying for real AI products. And right now, that side of the scale is worryingly light. At some point, that gap has to close. The investments have to start making real money, or the whole thing could collapse under its own weight.
And listen, this isn't some fringe theory. Some of the most buttoned-up, respected investment firms out there are sounding the alarm. Take GMO. They're famous for their data-driven, no-nonsense approach and for calling bubbles in the past. And they are not mincing words. They are calling the current AI market an extreme bubble and say it's destined to burst. When folks like that start using language that strong, you got to pay attention. Even the firms that are generally pretty optimistic about AI are pointing out some major risks. Vanguard, one of the biggest investment managers on the entire planet, is mostly bullish on AI's future. But even their own analysis puts the odds that AI fails to deliver the goods at 30%. Just let that sink in. A nearly 1 in 3 chance that this whole thing doesn't create the productivity boom that's needed to make today's prices make any sense. That is a huge, huge risk when trillions of dollars are on the table. Okay, I'll admit, that was a pretty compelling and honestly kind of scary case from the prosecution. It sounds an awful lot like 1999. But now it's time to hear the other side of the story. The defense is about to argue that this is not a speculative bubble. Not at all. They say what we're really witnessing is a fundamental shift in our economy, something as big as the Industrial Revolution itself. The whole argument for the defense really boils down to this one critical idea. The dot-com bubble was a business of bits. It was all about software, websites, digital stuff, things that were pretty cheap to create. The AI revolution, on the other hand, is a business of atoms. This isn't just about clever software. This is about a massive, expensive, real-world build-out of actual physical things. So let's look at what this physical build-out really means. To make AI work on a global scale, you need this complex 3-layer system. At the top, you have the cloud, these giant data centers where the massive AI models are trained. In the middle, you have on-premises servers, powerful computers inside companies that run those models to get answers. And at the bottom, you have edge devices, the powerful chips in your phone, your car, your factory that need to make instant decisions. Every single one of these layers requires billions in specialized hardware, chips, cooling systems, networking gear. This isn't just software in the cloud, this is heavy metal. And the scale of this build-out is, well, it's just mind-boggling. Check out this number, $6.7 trillion. That's the estimated investment needed just for new data centers by 2030 to keep up with AI demand. We're not talking about money for software licenses. We're talking about money for concrete, for steel, for power grids, for unbelievably advanced factories. This, the defense would argue, is what a real industrial revolution looks and feels like in the 21st century. And now we get to what might be the single most powerful piece of evidence for the defense. This is the smoking gun that really separates today from the dot-com era. Back then, you had companies worth billions with zero revenue. Today, the top AI companies are already generating an absolutely staggering amount of real money. Just look at these 2025 numbers. OpenAI was on track to bring in $13 billion in revenue. Its main competitor, Anthropic, was on track for $7 billion. These are not just ideas on a napkin. These are massive, high-growth businesses with actual products that customers are paying billions for right now. Okay, so we've heard two completely different stories. One is a tale of a dangerous bubble. The other is a story of a world-changing revolution. So to figure out where the truth might be, we need to cut through some of the hype. Let's shift gears and bust some of the most common myths that are floating around out there about AI. First up, there's this myth that all of big tech is basically the same thing. People talk about the Magnificent Seven, Apple, Microsoft, NVIDIA, and the others as if they're all just one big blob making the same bet. But that's not what's happening at all. The reality is their strategies are splitting apart. You've got companies like Google and Meta going all in, making these huge risky bets, trying to build the next god-tier AI model. And then you have companies like Microsoft and Amazon playing it more like a picks and shovels game. They're less focused on finding the gold themselves and more focused on selling the tools, the cloud computing, that everybody else needs. These are totally different bets with totally different risks. All right, let's talk about the biggest myth and the biggest fear of them all, that robots are coming for all of our jobs.
The story we hear is mass unemployment, right? Well, the reality, at least for now, is actually the exact opposite. The data shows we're in a phase that economists are calling superstaffing. AI isn't replacing people, it's acting more like a co-pilot, making human workers even better at their jobs. In fact, studies are showing that the jobs most exposed to AI, like coders and analysts, are actually seeing faster job growth and higher wages than other parts of the economy. Now, the long term is another question, but right now, the story is augmentation, not replacement.
And finally, there's this myth that the party's over, that investment has dried up and the IPO market is dead for tech companies. The reality is that the pipeline of private companies waiting to go public is still very active. In fact, 2026 is looking like it's going to be a huge sorting year. It's the year the market really gets to look under the hood of these companies and separate the real deals from the hype. We could see massive public offerings from giants like OpenAI and Anthropic, and that will be a massive test of whether the public is really buying into the AI story.
So, we've heard the arguments, we've busted some myths, but how do you actually make sense of all this for yourself? Well, in this next section, we're going to move from theory to practice. We're going to open up the toolbox and look at some of the key frameworks that professional investors use to analyze any market, including this one.
A great place to start is right here, with the 4 pillars of investing. It's a really solid, structured way to think about any potential investment. Pillar number 1 is fundamentals. Is the company itself actually strong and healthy? Pillar 2 is technicals. Is the overall market trend on your side? Pillar 3 is cash flow. Can you set things up to make money no matter which way the market goes? And finally, Pillar 4 is risk. What's the worst that can happen, and how do you protect yourself? Let's zoom in on that first pillar, fundamentals, because it's so important. This is the real detective work. It's about looking past the hype and the stock price and digging into a company's financial reports to see if it's actually a good business. You look at key numbers like price to earnings to see if it's profitable, price to book to see what the company's raw assets are worth, and price to sales to see how fast it's growing. This is how you figure out if a stock price is anchored in reality or just floating on air. Here's another powerful tool the pros use. The top-down approach. The big idea here is to stop chasing random hot stocks. Instead, you work like a funnel. You start at the very top and look at the whole market. Is it generally trending up or down? Then you find the strongest sectors, like tech or healthcare. Inside that strong sector, you find the strongest industry groups, like semiconductors. And only then, at the very end, do you start looking for the best individual companies. This whole process makes sure you've got the wind at your back. And this table is a perfect real-world example of how you can use these tools. Let's look at the critical AI chip space. Using fundamentals, we can see NVIDIA is trading at what seems like an extremely overvalued price. But the market narrative around it is that it's the undisputed king. Then you have AMD, the main challenger, with a more reasonable, but still high, valuation. And finally, you have old-school Intel, trading near its book value, meaning the stock price is almost what the company's assets are worth. The story there is a risky turnaround. See? Each one is a completely different kind of bet. All right, we have heard the case for a bubble and the case for a revolution, and we've got some new tools in our toolkit. So let's put it all together. What are the key things we should all be watching that will give us clues about where this is all headed?
Okay, beyond just the market numbers, there are some big external risks to keep an eye on. First, regulation. You have different states and the federal government all making their own AI rules, which could create a real legal headache for companies. Second, something called shadow AI. That's when employees use AI tools at work that the company hasn't approved, opening up huge security risks. And finally, there's a ton of geopolitical risk. A single policy change about who can buy certain chips could completely upend the entire industry overnight. If you want an early warning signal that things might be turning sour, here are 3 things the pros watch. First, look at the private markets. If the venture capitalists suddenly get spooked and stop funding AI startups, that's a massive red flag. Second, watch the pilot to production rate. Are companies just playing around with AI, or are they actually rolling it out to solve real problems? And third, watch for sector rotation. If you see big money suddenly selling off tech stocks and buying boring stuff like consumer staples, that's a huge sign that the smartest people in the room are getting nervous. So, what's a practical way to approach all this? Well, the sources point to 2 main strategies. First, diversify. Instead of trying to find the one winning stock, you can use ETFs, which are basically baskets of stocks. You could own a broad tech fund, an AI-specific one, or even a fund that invests in the power companies that will fuel this whole revolution. The second strategy is to go for the picks and shovels.
Instead of betting on the glamorous AI companies, invest in the businesses that sell them the essential gear. Things like cooling systems, networking equipment, and the construction firms that build the data centers. They win no matter who comes out on top. And let's end with this one final, really important thought. So, is there an AI bubble? Maybe. Is there a real AI revolution happening? Almost certainly. But the single biggest mistake anyone can make is to assume that the companies winning today are guaranteed to be the winners tomorrow. Technology always moves in this relentless cycle known as creative destruction, where today's giants are always under threat from the next big thing. And that constant change is probably the biggest risk and the biggest opportunity of them all.